Hi, welcome to the Market Alert for Friday, the 1st of April 2016. So yesterday the market up in the first 5 minutes of the session. The market struggling at the 17,750. We had a couple of buy signals there. Obviously the second one ignored because the first one was still in progress. The market then coming back and stopping this one out for a small loss. Then tried to move the market sideways. And at this point it looked like the market wasn't going to do a lot. And at this precise point as well, I sent a note out saying unless the volatility picks up, to stand aside. And then as soon as I sent the message out, the volatility picked up. We see this sharp down bar there, followed by the market then trying to race to the upside. And then just as we got into the evening session, the market moving to the downside there. And the reason for this is the market's waiting for the non-farm payrolls today. This market is exhausted from its recent up move. It's moved up, it's a dead cat bounce, and we're likely to see prices move lower. Now we're into April for this month, and then certainly we've got the old adage in May as well, sell in May and go away, but you're not going to have to wait that long in my opinion. I think this is going to be heading south very shortly. But today the market waiting for this one, the non-farm employment change. That's the one they're waiting for. As I said before, the Federal Reserve, two major economic news items, the FOMC minutes and the non-farm payroll figures are the two big ones for the market. And once we get this one out of the way today, it doesn't matter which way it goes, then we're going to see prices move lower. And the reason I say that is the implied volatility. 1148 yesterday, 1229 today. This is starting to move up. We've got the blue line below the yellow line now, so this is all set for the market to move higher. So, well, the implied to move higher, the underlying market to move lower. If we go back to June, July, you can see there that same thing. It took a few weeks before we had the big explosive move, but the market then, if we look at the underlying market once more, ran out of steam in July. You can see there just traded sideways and then moved sharply lower thereafter, and there we're in that same situation now where we've got the market sideways again with those lows in the implied volatility. So that's what's happening at the moment. It's very brief today. Say the market's waiting for the non-farm payroll figures, which will be released at 1:30, and it will certainly be very interesting to see what effect these have upon the market. But from this point forward, it looks like there's going to be some downside pressure. The economic news generally is not good. The global recession is on its way. We're 8 years into the last manufactured and inflated QE by the Fed, and that is coming to an end as we see now, which actually just reminds me of an article I read at 5 o'clock this morning. Let me just bring this up for you. So on Zero Hedge this morning, worst case scenario, 73% down from here, and as it says here, the stock market gyrates higher and lower in a fairly narrow range, which is what I was just talking about, aka July of last year. The spokesmodels and the talking heads on CNBC breathlessly regurgitate the standard bullish mantra designed to keep the muppets in the market. Absolutely. But as things get worse, we are likely to see things deteriorate here. If you have a look at the Fed's balance sheet, you can see how the market moved higher, where they were pumping money into the market. We then had the tapering, and you can see this market is really struggling and has been since the tapering came into effect under Yellen's watch there. What else have we got here? I've not actually seen this chart. It's hard to read on a mobile device. So we've got, actually I wrote about this back in 2011. And you can see there the employment figures dropping down. I don't know why Yellen keeps barking on about a strong labour market, but you can see there the effect in the S&P with the green line there and what has actually happened. So again, once the tapering got into effect, the whole thing started to fall apart, and the Fed are doing their best to actually stick with it. And in fact, there was another article on here. I'll just, while we're thinking about it, the Olympics in doubt as Brazil's sports minister quits. Not many people are aware of this. They've got a massive problem in Brazil, a financial problem that is, of course, at the moment. and not many people are aware they actually cancelled the Rio Carnival earlier on in the year as well, because owing to a lack of funds. So watch this one carefully. I'm sure it will go ahead. I mean, they'll find a way of making it happen, but it's interesting to see that the sports minister has quit at a crucial time. And also, I think it was on page 2, Gartman is the article I'm looking for, and he's absolutely right in what he says here as well, if I can find it somewhere around here. I'm sure it was on page 2, maybe it's on page 3 then. Well, it was basically saying not to fight the Fed. There you go. Gartman throws in the bearish towel, don't fight the Fed. Well, you've got to trade what the market shows, and obviously for the last 7 weeks it's been to the upside, but we are going to get a dramatic correction in this market. Whether we go back up again after, who knows, but the Fed will do anything to keep their Ponzi scheme alive. But the truth of this matter is you cannot fight the Fed. If they want the market up, they will keep pumping it up with the plunge protection team until they can no longer do it. But at the moment, obviously, looking at the last 7 weeks, they're still able to do this. Right, that's it for today. I will see you in Monday's edition of the Market Alert. As ever, thanks for watching, also for your support. See you in the next one.